Hey, what's up guys? John here. Happy New Year. 2024 will be the greatest year in American history to acquire hard assets, businesses, and build tremendous wealth.
In May, inflation hit 8.6%, the highest in 40 years.
Big tech companies like Meta, Google, and Amazon have been laying off a staggering amount of workers.
Americans are now using this buy now, pay later apps, which were once very big for purchases like electronics and furniture, to now pay for necessities like their groceries.
Over the next year, we're going to start to see so many people being forced to sell off assets. And this is going to mark the opportunity where consumers are going to be able to go out there and start to acquire and buy up these assets. But there's a lot of traps. There's a lot of bear traps being set right now in the economy, and they're being positioned as protections.
The Consumer Financial Protection Bureau is proposing a new rule to lower credit card late fees.
Biden administration pushing forward to change federal student loan regulations. It is announcing a new plan that would lower or pause payments for some Americans.
And for $1 million borrowers, they won't have to make any monthly payment at all.
But you have to be very, very careful you don't take on any of these protections, and you do not put yourself in a position to where you can't get funding. Because if you are, it's going to make things very, very challenging to be able to go out there and buy these real assets. We've come a very, very long way the last couple of years. In August of 2021, consumers had $2.1 trillion in excess savings. Now, less than $50 billion. And this is not taking into consideration any payments that were made on credit cards and personal loans on the 1st of January. So consumers are basically broke. But when you look at the chain of events that are incoming, you can see things for how they really are. The greatest rug pull in American history has been set, and it's getting ready right now to get pulled on tens of millions of Americans. But the big question is, who's going to go out there and buy up these assets? We know it's going to be the big corporations. We know it's going to be the big investors. But I think there's going to be a lot of small mom and pop investors as well that are getting on the sidelines. They're getting ready. They're getting anxious to go out there and pull the trigger to buy some of these incredible deals. And I'm going to break it down for you. I'm going to show you exactly what's going on. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's happening in America. And if you'd like to fix your credit to position yourself for this great wealth transfer, we'd love to help you if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report. Go to greatcreditfast.com, click the link in the description just below this video, schedule a free strategy session. We'd love to see how we can help you position you for 2024. Take a look at this. So delinquency rates on credit card loans. Look at this. This is going back all the way 2013. We're now, this is Q3 of 2023. We're already at record highs for the last 10 years. Now, when you look at what's going on, only half of Americans believe they can pay back their December credit card bill. This came out today, right? Only half. So what happens when people can't pay off their credit card bills? Well, they go delinquent, and then late payments show up on their credit report. And when the late payment shows up in your credit report, drops your credit score upwards of 180 points, and it'll stay on your report for upwards of 7 years. So preventing those individuals from being able to go out there and get good funding for a home or a rental property, right? So you start to look at this situation, then you look at what's happening right now with the CFPB, the Consumer Financial Protection Bureau, and the White House. They are working on a plan to reduce late fees from credit card companies from between $25 and $45 late fee to $8, so greatly reducing their profitability on lending money, these credit card companies. So when you're talking about cutting their late fees by 75%, you're going to see a situation where credit card companies are going to continue to tighten up on lending, especially if only half of Americans believe they can pay back their bills. What are they going to do? If you were a credit card company, what would you do? Probably lend less money, right? You'd probably be really selective on who you're going to lend money to. Well, look at what's happening right now with banks. The strength of large banks continues to mask the weakness of small banks. Delinquency rates on credit cards at small banks to 7.5%. I mean, payday loans are around 9%. So, you know, the installment loans where you can go to, you know, the corner spot and they'll give you, 2 weeks or a week to pay your little loan, $300, $500 loan. Well, that's 9%. So credit cards are 7.5%. It just goes to show how bad this is. This is a 200 basis points higher delinquency rates seen as smaller banks in 2008. It is even 50 basis points higher than delinquency rates seen at large banks in 2008. Since the Fed started raising rates, delinquency rates have more than doubled at both small and large banks. Consumers are still feeling the pain as inflation, higher interest rate, 130,000 views, right? So you look at this, you look at where credit card companies are at, where small banks are at, and now what this new Basel Endgame is going to be doing to banks and lending. So this capital endgame The largest international banks, including JP Morgan Chase, Bank of America Co., and Goldman Sachs, would see a 19% increase in capital requirements under the new proposal, meaning they have to have a lot more cash on hand, which obviously means they're going to be lending less money, right? Increase the capital requirements under the new proposal, according to the regulators, lenders with at least $250 billion in assets, but not deemed globally systemically important banks, would see a 10% hike, while banks ranging from $100 billion to $250 billion in assets would face a 5% capital increase. Supporters of the rule say that they're necessary to shore up banking systems in the wake of last year's regional bank failure, and the lenders can afford the higher capital requirements, but bank CEOs, trade groups, and Republican lawmakers have been pushing back hard against proposals, saying that coming capital increases will decrease lending and push risky activity into unregulated shadow banks. So it's very clear. But when you see these things, it makes me look at this. Try to see all the dots that are connecting, because you see what's happening with credit card companies with their fees. Then you look at student loans. Student loans are saying, hey, look, student loan borrowers, they won't face significant penalties for missed payments. But when you see this and you say the penalty, okay, maybe there is a penalty if you're missing a payment. But the real penalty is it going on your credit report. When it goes on your credit report and sits there for 7 years and it drops your score 180 points or 50 points or 100 points, everyone's situation is a little bit different. But when you see that massive drop in your credit score on the first month, and then you see a 60-day late fee, and then a 90-day late fee, and you start to see these fees might be small, but the collective late fees and late penalties on your report is going to be far more damaging than any monetary type of penalty. If that person has a specific intent to invest or buy a home or to get ahead financially and they need bank funding to be able to do that, having these late payments on the report is going to really make that challenging. So when you see this, student loan borrowers won't face significant penalties. You have to ask yourself why, right? They're reducing the likelihood and the downside of defaulting on credit card bills, knowing it's going to go on your credit report. Reducing the downside of student loans, knowing it's going to go on the credit report, right? What's happening? People are going to start destroying their credit reports, not by, they want to do it. They're going to be forced to do it. They're forced to do this. And so when you look at this situation, you're going to see a scenario where, coupled with what's happening right now with the banking requirements, with loans, it's going to get so much harder to get funding. It's going to get so much harder to get funding. People with the credit score, the 600s, the 500s, it's going to be damn near impossible. And when you look at how bad this situation's getting, you have 40% of all these 22 million borrowers that have yet to make a payment, right? 40%. This is December 20th. So you're talking about 9 million, 8.8, 9 million, somewhere in that range of borrowers that have yet to make these bills on their student loans. And so you think about this, what is this going to mean? Credit score is going to go down a lot. But as this is happening, massive layoffs are coming in 2024. And this is the year I believe AI is going to start to really start to become much more important. Now, ChatGPT, that was all the rage early last year. Everyone was talking about ChatGPT. Google just laid off, they're reportedly gearing up to lay off 30,000 employees in its ad sales unit in favor of AI. Think about that. Think about where AI is for them to be able to say, yes, we feel like we can replace 30,000 employees, right? I mean, IBM laid off 7,500 workers last year because of AI. And this is going to be the year where layoffs are going to start to really pick up. And if layoffs pick up, millions of Americans are not going to be able to make their bills, right? So this is the year, I'm telling you, it's going to be the year of the great wealth transfer. People are going to be forced to sell off assets. It's going to be harder to get funding and financing. But if you're putting yourself in a position right now to either clean up your credit report, save cash, get into the right business, get into the right job, maybe you have the right business or the right job. This is the year to put everything where it needs to be right now, so you can go out there and start acquiring assets and build out a mode of safety around yourself and your family. In 2023, 65% of business leaders say their companies already had layoffs, with 25% saying that they laid off 30% of their more of their workforce. In 2024, substantial numbers of the workforce may be let go, as 22% of the companies who plan layoffs this year said 30% or more of their staff will be fired. Who will be laid off first? While the overwhelming number of companies indicated layoffs to be expected in the new year, not all companies or industries are equally at risk. There's slight division in mid-sized to large companies compared to smaller companies. While 42% of mid-sized and 39% of large companies indicated layoffs are coming, only 28% of small company business leaders said the same. Industry-wide construction and software companies were by far the most likely to predict layoffs in next year at 66 and 65% respectively. Meanwhile, information, retail, finance, and insurance companies will likely see some employee turmoil as well, with 44% of information and retail companies and 38% of finance companies saying layoffs are anticipated. I mean, this is going to ramp up. Bankruptcies soar at the highest rate and end of this aid as business rate. This just came out a couple weeks ago, right? It's like you have corporate bankruptcies skyrocketing. I mean, you have a very unique trend inside of the real estate market. Now, every mortgage broker, everybody was saying, hey, the moment interest rates even come a quarter point, buyers are going to run out there and buy up everything. They're just going to run out there. They're going to be so excited, and the market's going to get a lot better. Well, interest rates went from about 8% to 7.5%, and U.S. pending home sales stuck at a 22-year low despite dip in rates, right? 22-year low came up 5 days ago despite a dip in rates. When you look at this, you're seeing July, 646,000 homes, compared to September, 700,000 homes, November, 754,000 homes. Home inventory is increasing walking into the winter with lower interest rates, and home sales are basically flat. What does this mean? It means that buyers, they don't want to buy at these price points, they can't afford to buy at these price points, and they see a lot more opportunity in front of us than they did behind us. They're not running out there anxiously waiving contingencies on inspections and appraisals. They're sitting with cash. That's what they're doing, sitting with a lot of money. So if you are thinking about investing in real estate, there's going to be a big opportunity. A lot of homeowners are sitting on a lot of debt. They're sitting on a lot of debt. Consumer credit card debt, student loan debt, they're sitting on all these different loan obligations. And so as credit scores continue to get obliterated, what we're going to start seeing is a lot of homeowners not being able to get second mortgages. They're not going to be able to get those lines of credit that they're accustomed to getting. And what's going to happen? People are going to get pushed and pushed and pushed to sell off assets. We're walking into a situation where we're never going to likely see this scenario unfold again. AI is going to play a massive role in the coming years to go, and this year is going to be the start of it all. So if you have big goals, big plans, don't wait until Q2, Q3. Start today. Put yourself in the best position possible to go out there and acquire assets and build wealth. If you have credit issues at all, we'd love to give you a free strategy session at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description to the video. Schedule a free strategy session. Catch you in the next one.